It is hard to believe there's only 1 week left in the year, 5 trading days if you want to look at it that way. 2008 starting next Tuesday. Will it be a year of promise for the markets, or could the bears stage a comeback? Maren Faiella and Todd Harrison are back with us. Zoom out. Woo, we have friends here now. There are some people here in the bar, believe it or not, as well, even though it's, early afternoon. So what do you think, Todd? First of all, 2008, what are we going to still have the same stories, biz stories that we've been covering for 2007? We're still going to see a continuation of subprime, housing, the Fed, interest rates?
Well, I think one of the major themes we saw this past year was inflation and things that we need to feed, educate, and power the world, and deflation and things we want, such as cell phones, plasmas, laptops. I think we saw that in Circuit City's numbers last week. I think next year we could conceivably see continuation of that, but we have to watch the dollar. If the dollar starts to rally, I would be careful in those sectors, and I would lean more towards consumer non-durables and pharmaceuticals. More traditionally more defensive sectors.
Dollar starting to strengthen just a bit here the last few weeks. So you're right. That'll be interesting to see if that continues. What do you think, Maren? What are you watching for next year?
I absolutely think the wild card is going to be the consumer. Certainly with oil rising, there's potential if oil hits $4 or above. This could really seriously affect our consumers, as well as the housing prices.
Gas.
Well, gasoline prices at $4.
Yeah, certainly. And if other things affect them, certainly as far as housing and numbers like that, the consumer's wild card.
Yeah, that's the thing that we've been watching a lot. People they have their most wealth, their biggest asset is in their home, and if that's falling on top of, as what Todd's talking about, where you have higher food prices, higher gas prices, higher health care, to heat your home and so forth. At some point, the consumer's just going to give out, but they've been pretty resilient, though, Todd. That's like the $6 million question. I remember 2 years ago on Cavuto's show, we're like, the consumer's tapped out, and look at them.
Well, I think it's cumulative, and I think just because it didn't matter then, it may not matter now. Now, I don't want to be too bearish, because we could see a lot of these interventionist policies and the money, the liquidity that's injected in the market, that can conceivably lift all those asset class boats again. But traditionally, intervention hasn't really worked all that well, so it's going to be an interesting year.
One of the things I've been kind of harping on, because I think it's important to get you guys' take on it for next year, is whether growth is a bigger issue for the Fed or inflation is a bigger issue, because to me, if inflation becomes a bigger issue, then the Fed can't cut rates as much as they want to. And it seems like this market is expecting or needing this Fed to keep cutting rates. So
I think they absolutely have to continue to cut. I think the market's expecting them to go somewhere down to about 3 to 3.5% before someone will want to buy a house again, before there's going to be some sort of additional liquidity available to banks to actually continue to see some sort of growth in our economy.
But do you guys get the sense now that after we saw these inflation numbers, I guess last week or the week before, that maybe they can't do that as freely as they wanted to?
I think that's a great point, because we saw through October the Fed was posturing for higher rates because, let's be clear, foreign holders of dollar-denominated assets haven't made money in 5 years, and I think in a globalized economy they've been trying to keep the dollar higher to appease those foreign holders of dollar-denominated assets. I think now with the slower growth, you have inflation again in things that we need, deflation in things we want. It could be setting up for a stagflationary environment.
That's scary.
It is scary.
None of us probably, have lived through or remember the stagflationary environment of the last time it came around, which was really the last time we had that seriously happen was right back in the 70s, right? Which was some bad times in this country.
I was wee big.
Yeah, I was just saying, we were around, but maybe Maren wasn't around. No, I don't know. No, we don't reveal ages here. But Maren, I always go back to the job market. If the job market stays strong and, their unemployment stays low, I think this is what has helped the consumer weather through all these uncertainties as well. But the job market's key out there, especially for next year as well.
Well, absolutely. And I think that what people are now seeing these days, and what we've seen in a lot of 07's message, is the sort of disconnect between the debt markets message to the market and the equity markets message. Debt market's screaming, the sky is falling, everything is falling apart, we're going to see an immediate recession. The equity market's seeing, growing GDP, solid balance sheets, and, potential lift in 08 further down the road because, again, these companies are sustainable. They may not be growing, but there's going to be a lot of, sort of fiscal responsibility among the consumers as well as the companies, but that could sustain our market going forward.
Good stuff, Maren. Thanks very much. And Todd, good stuff. We are just kind of getting warmed up here because from what I'm told, we got a pretty festive round of the old quick shots coming up next, so you don't want to miss that.